A 97% win rate looks impressive, but in trading it can quietly cap your growth. The obsession with winning trains you to play small, exit early, and avoid real opportunity. The market doesn't reward perfection, it rewards alignment with probability. Once you understand this paradox, you stop chasing wins and start unlocking the potential most traders never reach. Most traders don't enter the market dreaming of freedom or mastery. They enter chasing one number, a number that feels safe, a number that feels impressive, a number that promises certainty in an uncertain world. That number is a high win rate, 90%, 95%, 97%. The idea sounds irresistible. If you could just win almost all the time, trading would finally feel easy, calm, predictable, controlled. And that's exactly why it's dangerous. The obsession with near-perfect accuracy doesn't come from logic, it comes from psychology. Humans are wired to avoid pain, and in trading, losses feel like personal failure. A high win rate promises protection from that discomfort. It offers emotional shelter. If you're winning constantly, you don't have to confront doubt, fear, or uncertainty. You don't have to grow. That's the trap. Winning too often early in a trading journey creates a false sense of competence. The trader begins to believe that success comes from being right, not from managing risk. They associate confidence with correctness, not consistency. And slowly, without realizing it, they build an identity around perfection. This is where growth quietly stops. Traders chasing a 97% win rate start avoiding situations where losses are possible, even when those situations carry the greatest upside. They tighten targets, they exit early, they filter trades obsessively. They sacrifice potential to protect accuracy. Over time, their strategy becomes smaller, safer, and weaker. It feels good emotionally, but it caps performance permanently. You'll see it everywhere. Traders bragging about months with almost no losing trades, yet their accounts barely grow. Traders terrified of drawdowns, yet stuck at the same equity level year after year. Traders who refuse to scale, refuse to adapt, refuse to let winners run, because doing so might damage their precious win rate. Perfection becomes a prison. In the real world, some of the most profitable traders have surprisingly low win rates. They lose often, sometimes more than they win, but their winners are large and their losses are controlled. They understand something: most accuracy, chasers never do. Trading is not about avoiding losses. It's about extracting value from uncertainty. High win rate traders don't learn how to handle being wrong, so when the inevitable losing streak arrives, and it always does, they break, emotionally, structurally, psychologically. They overreact because their identity was built on being right. This is why so many traders collapse after a strong start. Early success masks structural weakness. The system wasn't robust, it was protected. Protected from volatility, protected from discomfort, protected from reality. And the market eventually removes that protection. Here's the uncomfortable truth most people never hear: if your strategy only works when you're right most of the time, it's fragile. It depends on conditions staying favorable. It depends on precision, it depends on control. And markets do not reward control, they punish it. Chasing a 97% win rate feels like ambition, but it's often fear in disguise. Fear of being wrong, fear of discomfort, fear of confronting randomness. Instead of building resilience, the trader builds avoidance. This is why high accuracy sounds impressive but rarely scales. The moment size increases, the moment volatility shifts, the moment execution pressure rises, the illusion cracks. What worked when things were calm collapses when things get real. The most dangerous part is that this trap feels productive. It feels disciplined. It feels intelligent. But it's quietly limiting your ceiling. You're not building a system, you're protecting an ego. And once you see this, you can't unseen it. High accuracy does not equal high potential. Winning often is not the same as winning well. And perfection is not proof of mastery. It's often proof that you're avoiding the very conditions required to grow. This realization is the first crack in the illusion. And once that crack forms, a new question emerges, one that changes everything. What if the goal was never to be right but to be robust? Perfection always looks clean on the surface, a smooth equity curve, long streaks of wins, very few red days. To most traders, this looks like mastery. But what almost no one sees is what perfection quietly removes from the process. Because the real cost of a 97% win rate isn't in the losses you take, it's in the losses you never allow yourself to experience. That missing 3% carries more information than the other 97 combined. Those losses are where feedback lives. They reveal weaknesses in execution, flaws in risk sizing, emotional leaks, and structural limits in a strategy. When a trader avoids them at all costs, learning slows to a crawl, comfort increases, growth stops. Perfection-driven traders unconsciously filter out the most educational trades. They skip entries that feel uncomfortable. They avoid volatility. They exit early to protect statistics. Over time, their decision-making becomes less about opportunity and more about preservation. Not capital preservation, ego preservation. The opportunity cost of this mindset is enormous. Markets don't offer value in neat, predictable packages. The highest-paying trades often begin with uncertainty, discomfort, and initial drawdown. They don't feel perfect. They feel wrong until they're not. By avoiding anything that might threaten accuracy, the trader opts out of the very situations that create asymmetric returns. This is how perfection limits profitability without announcing itself. Nothing appears broken. The trader still wins, still feels in control, still believes they're improving. But the account plateaus. The size never scales. The strategy never evolves. The ceiling is reached quietly, and the trader mistakes stability for success. Consider a simple scenario. Two traders take the same setup. One exits the moment price hesitates, locking in a small win and protecting their win rate. The other holds according to plan, accepts the risk of being wrong, and allows the trade to develop. In many cases, that second trade becomes a loss, and in that loss, something critical is learned about volatility, about timing, about emotional tolerance. Over time, those lessons compound into better sizing, better execution, and larger winners. The first trader learns nothing. They were right. Again, perfection feels like progress because it reduces pain. But pain isn't the enemy in trading. Unexamined behavior is. Losses force reflection. They force adaptation. They expose gaps that winning hides. When you remove losses from the equation, you remove pressure. And without pressure, systems don't strengthen. This is why traders obsessed with high accuracy struggle when conditions change. They've never trained for adversity. Their strategy wasn't built through friction. It was sheltered from it. So when volatility expands, when trends fail, when randomness increases, they don't adjust, they panic. The market doesn't reward perfection. It rewards resilience. It rewards those who can absorb information from both sides of the distribution, wins and losses alike. When you chase perfection, you're not optimizing for learning. You're optimizing for comfort, and comfort is expensive. The most dangerous part is that traditional success metrics reinforce this trap. Win rate, streaks, red days avoided. These numbers feel objective, but they don't measure growth. They measure how well you've avoided discomfort. They don't tell you whether your edge is robust. They tell you whether it's protected. And once you recognize that, a deeper question emerges. If avoiding losses is costing you your best opportunities, what are you really optimizing for? At some point, every serious trader has to make a decision that has nothing to do with strategy and everything to do with perspective. That decision is whether trades will be judged as wins and losses or as executions and lessons. As long as success is measured emotionally, learning stays random. But the moment execution becomes the metric, progress becomes deliberate. Losses don't need to be reinterpreted as good. They don't need to feel positive or motivating. They simply need to become useful. This is where most traders go wrong. They either avoid losses or they experience them emotionally and move on without extracting anything. In both cases, information is wasted. A professional reframes every trader's feedback. If the rules were followed, the trade was valid, regardless of outcome. If the rules were broken, the trade was invalid, even if it made money. This inversion alone changes behavior dramatically. It removes shame from losing and removes false confidence from winning. The simplest and most effective tool for making this shift real is an error journal. Not a performance journal, not a profit journal. An error journal exists for one purpose: to track deviations from process. Each trade is reviewed through a narrow lens. Was the setup valid? Was risk sized correctly? Was execution clean? Was the exit managed according to plan? No storytelling, no justification, just facts. When a loss occurs, the question is not, why did the market do this? The question is, what did this trade reveal? Sometimes the answer is nothing, random loss executed correctly. That's valuable data. It reinforces trust in the system. Other times the loss exposes hesitation, early exit, emotional interference, or sizing mistakes. Those are the losses that teach. Over time, patterns emerge. The same mistakes appear again and again, not because the trader is incapable, but because behavior is habitual. The error journal turns invisible habits into visible data. Once something is visible, it can be trained. This is how small losses become a massive edge. Each corrected behavior slightly improves execution quality. Each improvement slightly increases expectancy. These changes are invisible in the short term, but over dozens and hundreds of trades they compound. Not financially at first, but behaviorally. And behavioral compounding is what allows financial compounding to happen later. Most traders want breakthroughs. Professionals build systems that improve by fractions. One fewer impulsive exit, one cleaner entry, one better risk decision. Over time, These small adjustments create a trader who behaves consistently under pressure. That consistency is not motivational, it's structural. Learning in trading does not come from market outcomes, it comes from self-observation. The market provides randomness, the trader provides structure. When those two interact, information is produced. The traders who progress are the ones who collect that information instead of reacting to it. This is why losses are not the opposite of winning. They are the raw material for improvement. When treated correctly, they shorten the learning curve instead of extending it. And this is the quiet advantage most traders never develop. While others chase accuracy, the trader who reframes losses into learning is building something more durable than confidence, competence. Most traders are trapped in the cycle of perfection. They obsess over win rates, precision entries, and flawless execution, believing that each trade must validate their skill. This fixation isn't just a psychological inconvenience, it actively sabotages performance. It leads to hesitation, over-trading, and emotionally driven decisions. The good news is that the antidote exists, and it's deceptively simple focus on execution over outcome. Execution, first trading means committing to your edge, your plan, and your rules without the constant need to validate them with profit or loss. It is a discipline that requires mental clarity, patience, and a willingness to accept imperfection in the short term for long-term gains. While the trader obsessed with winning every trade measures success by immediate results, the professional measures success by adherence to process. Every deviation from the plan is a missed opportunity to improve. Every faithful execution is a micro deposit into the compounding account of skill and discipline. The first step in executing without chasing perfection is mental reframing. Stop seeing losses as personal failures. Stop measuring skill based on individual outcomes. Understand that in a probabilistic environment, results will vary, even if execution is flawless. One well-executed trade can lose, one poorly executed trade can win. The variable you control is process, not outcome. By shifting your mindset to this perspective, fear, greed, and frustration lose their grip. You stop exiting early out of anxiety, you stop forcing trades out of boredom, and you stop letting the desire to be right interfere with following your rules. Position sizing becomes a critical tool in this approach. By limiting risk per trade to a small, predefined percentage of capital, often 1% to 2%, you reduce the emotional impact of each individual trade. Small losses no longer feel catastrophic, which allows you to stay disciplined even when trades go against you. When you accept that no single trade defines your success, you begin to see the compounding power of proper sizing. Losses are absorbed without panic, and winners can run with confidence because your capital is preserved. Patience is another pillar. Many traders enter trades prematurely, close positions too early, or jump from setup to setup, chasing the illusion of perfect conditions. Executing without chasing perfection requires a methodical approach. You wait for your rules to align, enter positions according to predefined criteria, and then step back. Your focus shifts from watching every tick to monitoring adherence to your plan. The difference is subtle but profound. You trade less emotionally and more strategically. To illustrate, consider a hypothetical scenario. A trader has a setup with a 60% edge based on a tested strategy. In the past, the trader might have hesitated, adjusted entry points, or second, guessed signals because of fear of being wrong. By committing to execution without chasing perfection, the trader enters exactly as planned, places a stop according to the rules, and sizes appropriately. The trade initially moves against them. Rather than closing early, the trader allows the setup to unfold according to plan. Over time, this disciplined behavior produces consistent, compounding returns. The key is that the focus was never on the win, it was on execution. The win or loss became secondary, a byproduct of following the process. Another critical element is review and feedback loops. Executing without chasing perfection doesn't mean ignoring outcomes entirely. Instead, you analyze them systematically to refine execution. Each trade, profitable or not, is logged, reviewed, and categorized. Did I follow my rules? Did I deviate? Did I manage position size correctly? Did I interfere with the trade emotionally? Over weeks and months, these micro adjustments compound into major improvements in skill, discipline, and decision-making confidence. You learn to recognize patterns in your own behavior and correct them before they impact results. A live example could involve a trader who notices they frequently close winners too early out of fear. By consciously observing this behavior, they adjust their execution rules to let profitable trades reach their intended targets. Over time, this single change significantly improves expectancy and confidence, demonstrating the practical power of process-focused trading. The transformation is subtle but cumulative. Small, deliberate adjustments create a structural edge that no single perfect trade could replicate. Execution, first trading, also requires managing the emotional environment. Traders often sabotage themselves through environmental and mental distractions, notifications, noise, or overthinking. A critical component of executing without chasing perfection is minimizing these distractions. This might include pre-trade routines, focused work blocks, or journaling emotional states before and after trading. The goal is to create a mental container where rules, not emotions, govern behavior. Another nuance is avoiding over-analysis. Traders frequently seek perfect confirmation, waiting endlessly for every indicator to align. This creates paralysis. Executing without chasing perfection means defining clear entry criteria and following them consistently, even if all variables are not perfectly aligned. Over time, this disciplined approach builds trust in your system, reduces emotional interference, and enhances clarity under pressure. The confidence derived from reliable execution is far more sustainable than any temporary ego boost from a perfect win. It's also important to embrace compound learning from imperfection. Every trade executed faithfully, even if it loses, provides data. Did the market behave differently than expected? Was risk adjusted properly? Did I follow the rules without interference? Each insight extracted systematically compounds over time. The trader who embraces this perspective becomes resilient, adaptable, and capable of thriving in uncertainty. By focusing on execution rather than perfection, they harness the full potential of probability-based trading. Finally, executing without chasing perfection fosters long-term consistency. Traders obsessed with perfection are prone to burnout, emotional whiplash, and reactive behavior. By contrast, process-focused traders develop habits that are repeatable, scalable, and sustainable. They don't rely on luck or intuition, they rely on a system that works because it has been tested, refined, and followed rigorously. Over months and years, this consistency compounds into measurable edge, risk control, and psychological resilience. In essence, the lesson is clear: perfection is an illusion, process is reality. You cannot control outcomes, and trying to do so will undermine performance. Instead, define your edge, create rules for execution, manage risk, review behavior systematically, and embrace learning from each trade, whether it wins or loses. Execution without chasing perfection transforms every trade into a learning opportunity, every loss into a lesson, and every consistent action into a building block of long-term success. By applying this principle, traders stop reacting emotionally, reduce unnecessary risk, and develop a structural advantage over those still chasing flawless results. They learn to operate in environments of uncertainty, leverage probability, and make decisions grounded in logic, not desire. The compounding effect of faithful execution produces results that are invisible in the short term, but undeniable over months and years. This is how professional traders create lasting profitability, not through perfection, but through disciplined, repeatable, and deliberate execution. The transformation is not instantaneous, but it is profound. Traders who commit to execution, first approaches discover that their confidence comes not from winning each trade, but from knowing they are following their rules. They become less reactive, less emotionally driven, and more resilient in the face of market volatility. They stop chasing illusions and start building real, structural advantage. Executing without chasing perfection is, therefore, a mindset, a system, and a strategy all at once. It requires mental clarity, consistent review, disciplined risk management, and patience. But the payoff is immense: fewer emotional swings, better risk-adjusted returns, stronger long-term results, and the psychological freedom to trade without fear or greed dictating behavior. Every trade becomes an opportunity to reinforce discipline, refine execution, and compound professional skill. In this way, traders transform from reactive participants into strategic operators, capable of navigating uncertainty with calm, control, and confidence. Most traders are obsessed with the 97%, the trades that work, the ones that fit neatly into their spreadsheets and feed their ego. They celebrate these wins, polish them in their memory, and treat them as evidence that they are skilled. But the truth is more subtle and far more powerful. Real growth, the kind that compounds over months and years, comes from the 3% of trades that don't go according to plan, the trades that feel uncomfortable, inconvenient, or outright painful. This 3% is often hidden. It is the unprofitable trade, the mistake, the deviation from the plan. Most traders avoid it. They skip the post-trade review, rationalize the outcome, or convince themselves that it was just luck. And by doing so, they leave their potential undiscovered. They think growth comes from repeating success. It doesn't. Growth comes from embracing what is difficult and learning from what is not immediately gratifying. The compounding effect of this perspective is profound. When each misstep is treated as feedback rather than failure, skill improvement accelerates exponentially. One small lesson extracted today, applied tomorrow, and reinforced over a month creates behavior that feels automatic after a year. Consider risk management. A trader who consistently reviews their mistakes will notice recurring sizing errors, hesitation in execution, or emotional interference. Correcting these behaviors doesn't create instant results, but it builds a structural advantage that prevents large, confidence-shattering losses in the future. Similarly, strategy evolution depends on embracing the paradox. Traders often cling to the rules that work in hindsight while ignoring the ones that produced the uncomfortable 3%. But the uncomfortable trades often contain hidden patterns that reveal market nuances invisible in the profitable trades. A subtle correlation, a timing adjustment, or a pattern in volatility might only appear when observing the trades that didn't succeed. By ignoring them, traders limit their edge. By analyzing them, they expand it. Decision-making also improves. Most errors stem from reactionary behavior, exiting too early, over-adjusting, or trying to force a win. By studying and compounding lessons from the 3%, a trader trains their mind to pause, observe, and act according to a process rather than an emotion. Over time, this process becomes automatic. Decisions that once felt stressful or rushed now feel measured and deliberate. Emotional neutrality emerges not from meditation or willpower alone, but from repeated exposure to controlled discomfort and systematic reflection. Real-world case studies, whether public or hypothetical, reinforce this principle. Consider a trader who obsessively chased high percentage setups and ignored the occasional losing trades. For years, their P&L looked steady, but it plateaued. When they finally committed to reviewing each deviation from the plan, the 3%, their edge became visible. Subtle patterns in market reactions allowed them to refine entry points, adjust stops optimally, and reduce risk without sacrificing opportunity. Within a few months, what once seemed like small, inconsequential trades had become the foundation of a stronger, more resilient system. Another example, a trader who feared losses would overcompensate with tight stops, exiting profitable trades prematurely. After consciously analyzing the trades that were lost due to timing or slight misalignment, they realized that the trades themselves were valid, but their execution was flawed. By compounding the lessons from these minor missteps, they gradually expanded their ability to hold positions with confidence, allowing winners to run longer and improving overall expectancy. The principle is simple but counterintuitive. Consistent attention to what seems unprofitable creates a compounding advantage. Just like small deposits in a savings account accumulate into wealth over decades, small behavioral improvements, extracted from the trades that don't immediately pay off, accumulate into skill, consistency, and professional competence. It's invisible in the short term but undeniable over time. Most traders ignore this because it feels uncomfortable. They want validation, excitement, and quick wins. They measure progress with account statements, not with behavioral refinement. But compounding potential doesn't require instant gratification. It thrives on patience, repetition, and the courage to confront one's mistake. Viewing the 3% as an opportunity rather than a problem transforms mindset. Losses stop being threats and start being data points. The market stops being a source of fear and becomes a source of learning. The trader stops chasing the illusion of perfection and starts building a system that consistently produces results. Over months, this mindset shift compounds into an edge that is not only sustainable but almost invisible to competitors. While others overreact, overtrade, or overcomplicate, the disciplined trader quietly refines their approach, quietly learning, quietly growing. The ultimate takeaway is this: the path to long-term success is not in repeating the obvious 97%, but in systematically compounding the lessons hidden in the 3%. Ignoring it may feel easier, but it ensures stagnation. Engaging with it may feel uncomfortable, but it unlocks exponential growth. When viewed this way, losing trades are no longer liabilities, they are investments in skill, judgment, and professional resilience. This mindset extends beyond trading. In life, growth often comes from confronting what feels inconvenient, analyzing mistakes, and methodically adjusting behavior. The trader who compounds the lessons in the 3% becomes not only better at markets, but also sharper in decision-making, calmer under pressure, and more consistent in execution across any complex environment. By embracing this paradox, valuing the lessons over the wins, observing patterns in failure over celebrating success, and patiently compounding behavioral improvements, traders create an edge that is almost impossible to replicate. It is quiet, structural, and long-term. It is not glamorous, but it is the foundation of lasting profitability. And this is the hidden secret that separates professional traders from the rest. While everyone else chases high win rates, the professional compiles knowledge, habits, and execution skill from the trades that initially seem unprofitable. They are not lucky, they are deliberate. They are not fast, they are consistent. They are not seeking ego validation, they are compounding potential, quietly, invisibly, and irreversibly. Trading is never just about trading. While most traders focus narrowly on entries, exits, and profits, the true power of the craft lies in what it teaches about discipline, emotional resilience, and long-term thinking. The habits you build, the mindset you cultivate, and the mental clarity you develop in the markets are transferable assets. They shape not only your trading results, but also your life beyond the charts. This is the final stage, going beyond trading to unlock your full potential. The foundation of this stage is mental resilience. Traders who embrace all outcomes, wins, losses, and break-even trades develop a psychological muscle that is invaluable. Every time a trade does not go as expected, you practice observing the result without judgment, without self-recrimination, and without panic. Over time, this becomes a reflex. You respond rationally instead of emotionally. You no longer tie your identity to short-term outcomes. In trading, this allows you to survive drawdowns, stick to your rules, and capitalize on opportunities while others panic. In life, it translates to navigating uncertainty, managing stress, and maintaining focus under pressure. A critical element of this resilience is the understanding that control is always internal, never external. In trading, you cannot control the market, you can only control your actions. Similarly, in business, relationships, and personal growth, outcomes are influenced by factors outside your direct control. The lesson of trading is to optimize what you can influence and accept what you cannot. By consistently acting within your sphere of influence, you build confidence that is unshakable and decisions that are deliberate. You stop wasting energy chasing perfection in outcomes and start building mastery in process. Another key element is confidence derived from consistent action. Traders who execute their edge systematically develop a sense of certainty that is divorced from market movements. This type of confidence is not arrogance, it is earned trust in your preparation, planning, and adherence to rules. Outside of trading, this principle applies to any skill or endeavor. Whether launching a business, learning a new craft, or pursuing personal development, confidence emerges not from intermittent success, but from discipline applied consistently over time. By focusing on what you can do rather than obsessing over what might happen, you cultivate a mindset that is stable, calm, and forward-looking. Emotional neutrality, cultivated in trading, becomes a superpower in life. When you can observe market fluctuations without reacting, you are also able to observe life's challenges without losing composure. Difficult conversations, career setbacks, unexpected financial events, all of these become manageable when your internal state is anchored in principles rather than outcomes. You learn to respond rationally instead of reacting impulsively, to see opportunities instead of threats, and to make decisions aligned with long-term objectives rather than short-term fears. The next aspect of unlocking your full potential is translating trading lessons to growth opportunities. The discipline you build in risk management teaches you about personal responsibility. The patience required to let trades unfold teaches you about deferred gratification. The resilience you develop through losing trades teaches you about perseverance. Every psychological skill honed on the charts has a direct parallel in business, relationships, health, and self-improvement. For example, a trader who meticulously journals every trade and adjusts strategy accordingly can apply the same rigor to improving productivity at work, learning a new skill, or managing complex projects. This systemic approach amplifies results across all areas of life. A practical application of this mindset is leveraging small, repeatable actions for compounding impact. Just as a 1% daily improvement in trading grows into a significant edge over time, small, consistent improvements in personal growth, health, or business compound into extraordinary results. By focusing on process rather than outcome, you avoid the trap of chasing immediate gratification. You shift your focus from "I need to succeed right now" to "I need to execute my plan consistently." In both trading and life, this builds a structural advantage that creates long-term leverage. Visualization and planning are also crucial. Traders often use charts, notes, and setups to guide decisions. This practice can extend beyond trading. By documenting goals, progress, and lessons learned, you create a feedback loop for continuous improvement. This method prevents stagnation, keeps you accountable, and ensures that every action contributes meaningfully to your long-term vision. Whether it's financial planning, fitness, or learning, the principle remains the same: small, informed actions compounded consistently yield extraordinary results. Another essential lesson is embracing failure as a teacher. Traders who fear losses never maximize their potential because fear distorts decision-making. When you accept that losses are inevitable and necessary for growth, you free yourself to experiment, innovate, and improve. This applies in all areas of life. starting a business, pursuing a creative project, or taking on a challenging role all involve risks. Those willing to treat setbacks as feedback, not punishment, accelerate their learning curve. The mindset shift from "I cannot fail" to "I will learn from failure" is transformative. Beyond learning from failure, embracing long-term perspective is vital. Many traders quit just before their systems demonstrate full potential. Similarly, in life, people give up too soon before consistency, persistence, and compounding pay off. Understanding that results are a product of time, patience, and repeated disciplined actions allows you to persevere. The mindset of the professional trader, methodical, patient, and resilient, is exactly what enables high performers in any domain to achieve extraordinary results. Integration into daily life is the final frontier of unlocking potential. The routines that support successful trading, structured planning, focused execution, and reflection can be mirrored in personal habits. Morning routines, journaling, exercise, and deliberate learning all become platforms for developing the same qualities cultivated in trading. Over time, these practices create identity, level change. You stop seeing yourself as someone who trades and start seeing yourself as someone who consistently acts with purpose. This identity shift is profound because it ensures that results are not dependent on fleeting motivation. They are a natural byproduct of who you have become. The compounding effect of integrating trading principles into life is significant. Emotional stability allows for better relationships, clearer decision-making, and more effective problem-solving. Consistent process-oriented actions accelerate skill acquisition in business, creativity, and personal growth. Patience and long-term thinking help navigate uncertainty without fear or impulsivity. Risk management principles teach responsibility and foresight. Confidence grounded in execution replaces ego-driven validation. In essence, trading becomes not just a source of income but a training ground for personal excellence. Finally, the journey beyond trading is about taking ownership of your potential. You have learned to detach from outcomes, act consistently, manage risk, and observe emotions without interference. These skills equip you to pursue ambitious goals, handle complex challenges, and create lasting impact in any sphere. The next step is action. Apply the discipline, process, and mental clarity you have developed on the charts to your broader life. Start small, measure consistently, and refine relentlessly. Over time, this creates compounding results that far exceed the immediate rewards of any single trade. The ultimate takeaway is this: trading is a mirror of life. The discipline, patience, and emotional mastery you cultivate in one domain directly transfer to all others. By embracing every outcome, focusing on execution, and committing to consistent improvement, you unlock your hidden potential. You don't merely trade, you train yourself to thrive in uncertainty, to grow through adversity, and to achieve results that are sustainable, scalable, and deeply fulfilling. The call to action is clear: start your journey now. Don't wait for perfect conditions, ideal opportunities, or external validation. Begin integrating these principles into your daily routine. Reflect on your execution, embrace learning from every outcome, and apply the mindset to every challenge in life. The more you commit to this process, the more your potential compounds, eventually unlocking levels of personal and professional performance that once seemed out of reach. In conclusion, the journey beyond trading is not a separate path, it is the natural extension of disciplined, process-driven action. By embracing all outcomes, executing consistently, and transferring your skills beyond the charts, you achieve mastery not just in trading but in life itself. You become resilient, confident, and capable of extraordinary growth. You stop reacting to circumstances and start shaping them. You stop chasing perfection and start creating sustainable advantage. And in doing so, you unlock your full potential, leaving behind fear, uncertainty, and limitation, and stepping into a life defined by skill, discipline, and unstoppable progress.